All right, we've got big breaking news coming in. The Reserve Bank of India has cut the repo rate by 0.35%. The repo rate now stands at 5.4%. Essentially, what this means is that if banks decide to translate this rate cut, it will mean cheaper loans for all your home loans and other loans as well. But the expectation was only a 0.25% rate cut. The rate cut has come in at a higher level, obviously, because of the kind of economic conditions that we are in at this point. Let's also go across to our Executive Editor, Faye D'Souza, who's joining me at this point. Faye, 35 basis points cut from the RBI. The expectation was only a 0.25%. So obviously the Reserve Bank is taking into account the macroeconomic situation, the slowdown that we've been facing in the economy.
Well, Avni, either the Reserve Bank of India is taking into account the slowdown or it's facing a fair amount of pressure from the Finance Ministry and the Government of India, because we've heard the Finance Minister herself mention this several times over the last week about the fact that the Reserve Bank of India ought to cut rates at this point. A rate cut is something that would help a great deal. And there has been a lot of talk about the fact that we are in a very depressed economy. The economy has slowed down. Every single indicator of the economy has slowed down as well. So there's absolutely no silver lining at this point. So this rate cut will come as a boost to the stock market that's actually suffered a great deal for the last 1 month. As we've talked about, it will come as a boost for business, because business will be looking to borrow more, and the growth in credit shows a sort of indirect growth in business. And home loans, of course, is good news for for the general population and for anyone looking to buy a home, although there haven't been too many people looking to buy a home lately. I just want to point out one thing. If you're hoping that your car loans or any other kind of loan will come down, well, those are fixed loans, so that rate doesn't change for the tenure or the life of that loan, but any new loan would come down. So this would be something that the auto industry would cheer to some extent. The real estate industry would cheer, and of course manufacturing would find this a big relief, because manufacturing has to borrow in order to make business function. It's the lack of liquidity really that the entire economy has been suffering from, and we hope that this gets passed on as quickly as possible by banks to customers, and secondly, that it helps in some way for the economy. Avni?
Yes, absolutely, Faye. In fact, at that point really, because, how much will this result in cheaper home loans is really the question, because we've seen now this is the third or fourth rate cut by the RBI, if I'm not wrong, in succession. And we haven't seen the home loan rates really come down by the extent that the RBI has reduced rates. So even though, and this despite the fact that there has been a push from the Finance Ministry to tell banks, from RBI to tell banks to sort of transmit the home loan rate cuts, but that's really not happened as it should.
Absolutely, and there's a reason why it hasn't happened, Avni. The reason is NPAs. The reason is the amount of money that gets locked into NPAs. Now remember, and you know this because you've tracked the sector, but when there are NPAs or non-performing assets, the banks have to do something called provisioning. They have to set aside a certain amount of money just in case someone doesn't pay that loan. So there is that provisioning costs it a fair amount of funds. Plus there is the amount that has to set aside with the RBI. So the problem with the banks right now is just the risk aversion of they don't want to make things worse by lending more. And secondly, the fact that there's no money. There isn't as much money that they're comfortable lending as they would have liked to, which is why really the home loan customer is always the last to receive the benefit, which is why we haven't seen the rates actually come down. But the Finance Minister has been fairly clear and categorical about the fact that she wants these rates passed on. So one would hope that that stern message gets followed by banks at this point.
Absolutely, Faye. And if I can I've just pulled out the RBI document on the policy, and if I can just take you through some of the important points as far as growth is concerned. So it says essentially that various high-frequency indicators suggest weakening of both domestic and external demand conditions. The business expectations index of the Reserve Bank's industrial outlook also shows only muted expansion in demand conditions. So essentially, RBI has made a lot of points as far as the growth is concerned, and it is obviously talking about the core data that we spoke about, core industrial data that we spoke about a few days ago as well. All of these points is what the RBI has listed out and is going to watch out for as far in the coming months as well before the next policy phase.
that FY19-20 GDP has been revised downward from 7% to 6.9%. This is again coming from the RBI themselves. It's something that people are going to be concerned about, that the RBI has revised the GDP growth expectation for this financial year FY19-20 from 7% to 6.9%. Again, another indicator, Avni, that we can add to the pile of indicators that have actually been that has come out. Gurcharan Das is on air right now. Forgive me, Avni, do you want to take over?
Yes, Faye. In fact, all right, we've got Gurcharan Das, economist, who's joining us on the phone line. Mr. Das, thank you so much for joining us. Your first reaction, this is a 35 basis points cut from the Reserve Bank we're seeing, which is more than what was expected.
Certainly, I had thought it would be 25.
Yes.
And it's 35, and that's welcome from my perspective. I think it will enhance, it will help growth. That's the real need of the hour. I don't think we need to be worried about inflation.
Yes.
And so we are in this cycle of declining rates, and that's a good thing. I think our rates have always been too high, and so the better. It's a good step. It's a good step. It will help. Now the question is how to get these rates passed through the banking system, which has been resisting it. And the banking system has been resisting it because they've been burned with all these NPAs. And so it's also understandable that they are very scared of lending. But I hope that that the competition between them and if at least the private sector banks will take the lead, the public sector banks should also follow.
Right, Mr. Das. That's of course the crucial point here, is how much of this is actually going to transmit into lower rates. That, like you pointed out, the system has been resisting making loans cheaper, despite despite the RBI asking banks to do that. But the other question also is that this 35 basis points comes at this time, and how much room is there for further rate cuts? Because this might be perhaps one of the last chances to cut rates, given the extent where we are at this point.
Well, I think that there is still room, and India's rates are still high compared to world standards, and so I feel that we should continue in this virtuous cycle.
Right. And the other part, of course, the commentary from the Reserve Bank, it has cut its expectation or its forecast.
Met on 5th, 6th and 7th August 2019 and deliberated over the evolving macroeconomic outlook against the backdrop of recent developments and incoming data. Today, the MPC voted unanimously to reduce the policy repo rate and to maintain the accommodative stance of monetary policy. As set out in the MPC's resolution, 4 members voted for a reduction in policy repo rate by 35 basis points, while 2 members voted to reduce the policy repo rate by 25 basis points. I take this opportunity to express my gratitude to the MPC members for their valuable and insightful discussions that culminated in the policy decision. I also wish to thank our teams in the Reserve Bank and express my appreciation for their hard work and dedication with which they supported the MPC's work. In reviewing global developments, the MPC noted that global economic activity had slowed down in emerging market economies. Financial markets have turned volatile on the back of monetary policy stances of major central banks and the uncertainty generated by trade and geopolitical tensions. On domestic developments, the MPC observed that the southwest monsoon is rapidly catching up, with the cumulative rainfall being 6% below the long period average and 25 of 36 subdivisions having received normal or excess rainfall as on 6th August 2019. The India Meteorological Department has forecast normal rainfall in August and September. Catch-up is also underway in the area sown under Kharif crops, which is now only 6.6% lower as on August 2nd than a year ago. Industrial growth measured by Index of Industrial Production moderated in May, pulled down by manufacturing and mining. Electricity generation picked up on strong demand. The manufacturing PMI rose to 52.5 in July from 52.1 in June, underpinned by pickup in production, higher new orders, and optimism on future demand conditions. High-frequency indicators of services sector activity for May-June present a mixed picture. Indicators of rural and urban demand as well as construction activity weakened, whereas domestic air passenger traffic turned positive in June after 3 consecutive months of contraction. The services PMI expanded to 53.8 in July from 49.6 in June on increase in new business activity, new export orders, and employment. Retail inflation measured by year-on-year change in CPI edged up to 3.2% in June from 3% in April-May. Food inflation rose to 2.4% in June from 2% in May and 1.4% in April, while inflation in fuel and light group moderated. Excluding food and fuel, inflation remained unchanged after having fallen by 50 basis points to 4.1% in May from 4.6% in April. The softness in inflation in this category was broad-based. Inflation expectations of households moderated by 20 basis points for the 1 year ahead horizon. Merchandise exports contracted in June 2019. Imports also contracted. And as the fall in imports was larger than that of exports, the trade deficit declined modestly during May-June on a year-on-year basis. On the financing side, net foreign direct investment flows moderated to $6.8 billion in April-May 2019 from $7.9 billion a year ago. Net foreign portfolio investment flows in the domestic capital market amounted to $2.3 billion during the current financial year so far, that is up to 5th of August, as against net outflows of $8.5 billion in the same period last year. India's foreign exchange reserves were at $429 billion on August 2nd, 2019, an increase of $16.1 billion over end March 2019. In view of these developments and considering that inflation for first quarter of 2019-20 was in alignment with its June projections, the MPC has retained its inflation projection at 3.1% for Q2 2019-20 and revised the projection for H2 2019-20 to 3.5% to 3.7% with 3.5% to 3.7% with risks evenly balanced, from 3.4 to 3.7% projected in June. CPI inflation for Q1 2021 has been projected at 3.6%. The MPC has revised downwards the projection of real GDP growth to 6.9% for 1920, and this consists of 5.8 to 6.6% for H1 1920 and 7.3 to 7.5% for H2, with risks somewhat tilted to the downside. This is against 7% which the MPC had projected in the earlier meeting in June. And at that time, the projection, as you would recall, was 6.4 to 6.7% for H1 and 7.2 to 7.5% for H2 of 1920, with risks evenly balanced. The downward adjustment in GDP growth projection was warranted by various high-frequency indicators pointing to weakening of both domestic and external demand conditions. On the other hand, the MPC was of the view that the impact of monetary policy easing since February 2019 is expected to support economic activity going forward. The MPC has voted for a policy rate reduction of 35 basis points instead of conventional 25 basis points. Let me explain the rationale underlying this action. Considering the evolving macroeconomic outlook, the Reserve Bank has been preemptive in its monetary policy actions and stance. Since February 2019, it has reduced the policy repo rate by a cumulative 75 basis points till today's meeting. In addition, it has changed the stance of policy from neutral to accommodative, which is effectively a further reduction in the policy rate since it takes rate increase off the table, while committing to either rate reductions or status quo going forward. Furthermore, sufficient liquidity has been provided to the system, resulting in overnight money market rates trading below the policy rate throughout July and August so far. In today's meeting, the MPC judged that with inflation projected to remain within target, addressing growth concerns by boosting aggregate demand, especially private investment, assumes the highest priority at this juncture. Against the backdrop of policy actions taken so far, the MPC felt that it is prudent to remain accommodative. While remaining consistent with inflation mandate, the MPC considered it necessary to calibrate the size of the policy repo rate cut to the dynamics of the situation. Accordingly, the MPC was of the view that the standard 25 basis points might prove to be inadequate in view of the evolving global and domestic macroeconomic developments. On the other hand, reducing policy repo rate, say by 50 basis points, might be excessive, especially after taking into account the actions